The Bank of Canada has come out with another massive rate hike this morning. It was 75 basis points, which was widely expected. The markets had largely priced that in, but let's not forget, since March, this is the fifth rate hike in a row. We are now up 300 basis points higher than we were in February. Overnight rate sitting at 3.25%. Why are they doing this? Well, of course, they still have the number one mandate of fighting inflation, which is still high. Right? Remember, we are at 7.6% here, and their target rate is between 2 and 3%. So what came along with the press release this morning when they talked about their rate hike? Well, they said the economy is still operating in excess demand. GDP in Q2 printed at 3.3%. And while that missed expectations, it's still quite strong. And really, what they're saying is people are still kind of spending too much. There's still all this froth sort of in that marketplace, not in housing per se, but, in the spending marketplace. And so they have to fight it. And the only way they can is by raising interest rates. Understandably, this is having a massive effect on the housing market and will even more so after today's announcement. So to help cut through the noise, to help give us some specifics and to definitely talk trigger rates, we have Mychal Ferreira from the Bank of Montreal, their lead mortgage specialist here to talk us through it. Mychal, as always, thank you so much for being here today.
Thanks, guys. It's always a pleasure. And here we go again, another big increase, and it's kind of like more of the same the last little while here. And, so jumping right into trigger rates, right? Because that's the topic of conversation these days. My guess and a little bit of research behind it is I believe there's about 600,000, give or take, mortgages across Canada that will be affected by trigger rates. And the main issue with the trigger rate, it's not the be-all, end-all, right? Because it's kind of the precursor. And the trigger rate basically means that you are now 100% of your payment is going towards interest, and you're now no longer making the appropriate principal payments. So overall, it's not, great because as your interest payments are stacking up, your amortization is slowly getting pushed out. Now, the more important part is the trigger point. That's when we're seeing, the banks mandate to a point of, you're going to have to increase your payment a certain percentage or make a lump sum to ensure that your amortization comes back into line. That's when, things are going to get a little hairy. So, trigger rate is a warning, which is kind of where we're at right now. Trigger point is, you need to action. So we're not too far from that, but I think right now we're still, people still have some time to make some changes.
Gotcha. So as a variable rate mortgage holder, what options are banks going to be giving people?
Yeah, so the three main options that we're seeing right now is to increase your payment by a certain percentage. That's still yet to be decided, depending on, an individual basis or a corporate basis, depends on what they decide to do. Do a lump sum, again, amount to be determined, or convert into a fixed. All of those three, options, when it is mandated, I do believe that will be to bring your amortization back to its contracted amortization. So, for instance, if you started at 30 years, you're 2 years in, you need to now be at 28 years. We're seeing some amortizations, at 50 years right now because of the increases. So, what would likely happen is when you choose one of those three options, it will bring you back to your allotted amortization.
Got it. Okay, but let's talk here in Vancouver, where we know housing is expensive. That means higher than average mortgage amounts. What kind of dollar figure can people expect here to be increased by per month?
For sure. So, on average, they're saying across Canada it's about $200 per person per variable, right? But right now, I would say that in BC, the average mortgage is obviously significantly higher, and we're seeing a 20% increase, which brings you just about where you're supposed to be from an amortization standpoint. It's going to be anywhere between $350 a month, all the way up to $600-700 a month. Obviously, $600-700 being a $1 million mortgage, right? And $350 around $500. I believe that would be a realistic increase to pull you into the proper amortization.
That's not a small number.
No.
I mean, if we're talking $700 a month, okay, the average home over the last year, 1.2 million average. So to buy into that, you are sitting around that $1 million price point if you are talking about buying with that minimum 20% down. So you're in essence saying $8,000-ish a year increase in payments over and above what I was paying last year.
Yes, that's correct.
And again, that's a significant change to people's pocketbooks. Let's be honest here. And when you had the governor saying that, you know, they were guaranteeing low rates till the end of 2023.
Yeah.
Here we are, you know, just into Q3 2022, and all of a sudden you're asking me to pay another $8,000 a year. That, for many, I could imagine, was not budgeted for, and we're obviously going to see the impacts of that.
Yeah, I also think, you know, we're seeing these rates increase, and we're not seeing wages increase by anywhere near the same margins. So the debt servicing ability for a lot of these people is going to get very difficult. And I think putting existential pressure on households and families to just stay ahead at this point. It's terrifying, honestly speaking, especially for those on fixed income who are likely already at their max. And Mychal, maybe you can explain touch on this a little bit, but when people were getting stress tested, they weren't getting stress tested to this amount, were they, in terms of growth?
No, I mean, when you look at the original, the 5.25 stress test, it's like we're here, right? We are now officially stress tested. And, you know, the one thing that you have to remember is that we use gross income, right? We use, and the ratios are typically about, you know, 44 all the way up to 49% of your gross income towards total debt, including the stress tested payment. So, you know, when you think about, okay, well, when you net that, and then you add the actual cost of what it is today, I mean, it's we're here. We're definitely, this is what they tried, the reason they did this in the first place. But, you know, I think overall, you know, even though we've seen these increases, and people are starting to make changes. I mean, a lot of my customers, they are, you know, I've had this conversation every time. You know, I show people the differences between fixed and variable, and, you know, did I prepare for this level of increasing rates? Absolutely not. Did anyone? No. I mean, this is obviously historical what we're going through. But, you know, I've showed the difference between where you are today fixed, where you could be tomorrow variable. And I think as long as people were able to understand that, they could prepare to some degree. I think the scary part is the people who didn't have that explanation. You know, suddenly, you know, if their payment goes up $300, $400, $500, it's hard to find that kind of income. So, you know, the stress test served its purpose to get us here. The question is, where do we go from here?
So now we're in uncharted territory, in other words.
Absolutely.
Let's give a bit of a real world example then here, just so we can demonstrate further how extreme these increases have been. So, Mychal, let's say I wanted to buy a home that needed a $1 million mortgage, which again is fairly common in our town here. Yeah. $1 million mortgage. What did my payments look like back in February compared to what that same $1 million mortgage would look like for payments today? And if you don't mind giving us both fixed and variable options.
For sure. So if you look at January earlier this year in 2022, you're at about 3%. So rates were hovering about 3% for a fixed, right? Fixed 30 years. You're looking at about $4,206 a month, right? Whereas today, I think on average, you're about 5.24%. Again, some variance in fixed rates there, but you're at $5,482 right now per month. Right.
$1,200.
So it's about a $1,200
a month.
Yeah, a month. Yeah.
Wow. Okay.
The variable one's a little more staggering, right? Because if you look at 1.59% 5-year variable in January, you're at about $3,493 per month, whereas you're today at 4.85%, which is the new increase. You're at about $5,247 a month.
Ooh. Yeah. $1,700 a month.
So, you know,
okay,
that's $20,000 a year.
Yeah.
More.
Yeah. Overnight, you know, I mean, I say overnight. No, it's been like, you know, over the last months, but, you know, if you look at the last increase to today, I mean, yeah, it feels like overnight, right? Because, you know, prices, although they're softening, haven't come down enough rates are chasing the payments up, and prices are slowly getting chipped away. So, I feel like all it's really done is made real estate even that much more expensive. All right?
Well, it's funny because you look at the federal government, the provincial government, and their promises to help people get into the marketplace, right? And here we are today raising rates, and if anything, the gap we've seen in sort of your $1 million plus, $2 million plus, sure, we're seeing a little bit of movement starting to happen there, but the vast majority of the market in the lower end, say the $400,000, $500,000, $600,000 mark, those prices haven't changed. Because that's what that buyer pool, that's what they can afford. And so the competition still exists there. What's actually happening is the bottom end of the market's now getting forced back into rentals, right? And that's not helping home ownership or equity growth or any of that effect. So it's actually, in many ways, a huge disservice to Canadians.
Yeah, I feel like, with everything happening now, a lot of it doesn't make sense. Right. And, when you look at, like BC and Ontario, it just operates different. Right. And, I feel like the blanket approach across Canada affects everyone, but affects some more than others. And, here we are massively increasing people's spending on the same property value, arguably the same property value. So somehow between all of this, all we did was make real estate more expensive. And it's tricky, right?
A little bit to that, Mychal. I mean, the government's typically their first move is to kill demand. When if it was dealt with early enough, you could fix it with supply, right? And so the demand destruction approach leaves us in the sort of predicament we're in. Whereas if we went about the supply approach, building faster, building more, building everywhere, it would have changed, I think, dramatically the outcome of interest rate hikes. But,
well,
I'm not in control of building permits, am I?
No. I mean, none of us are, right? And all we can do, I think prices will adjust. Interesting stat that I pulled up in the last 30 years. When Bank of Canada has increased rates more than 1.5% in a year, they've usually followed it by a period of time where they've decreased rates by anywhere between, again, 1.5 all the way to 5.25 in the last 30 years, right? Wow. So, what we're seeing is, this might be a sharp rise up, and equally sharp down, right? So, as bad as things are getting now, I think there's a breaking point. But I mean, it's all cyclical, right? I mean, I think that what we're seeing is just an attempt to try and fix what's happened in the last couple of years, and the question is just how long it will last and how far they'll push, right? Because I think at some point they need to think differently. It's just they're always operating in the rear view, They're always looking at what has happened.
And in the demand destruction phase, right?
Yeah. I mean, the main purpose of increasing rates is to calm demand, but the demand is still arguably there, right? I mean, people are still...
I mean, I want to calm... We'd love to calm demand, but people need a place to live. Yeah. And I mean, until you're dealing with that, it's a whole reason to be here. It's what people do. Yeah. They work their whole lives to provide shelter. So, it's a real need. And honestly speaking, I mean, we could get really into the long of it, but I mean, it comes down to, a very poor policy in the long run, right? A very poor long run policy here. We're just not creating enough homes for the people that we're continuously either coming to the country or the population growth that we're going through, especially in these major centers. I really like the idea that you bring up of a not necessarily using a blanket approach to interest rate hikes or, especially in different demand sectors, right? It's very interesting.
Well, I don't think you can't paint everyone with the same brush. I mean, they do, and of course that will continue. But I think in general, it's we're still seeing, the average, but the interesting thing the other part of this, which I find incredibly interesting, is, which you're not really hearing a lot about, is a lot of people right now are actually getting pre-approved, getting their ducks in a row, and they're just sitting around and waiting. I've had a massive uptick in pre-approval applications. I've had a massive response of people coming back who've been sitting on the sidelines for the last couple of years, that were frustrated that they couldn't get into the market, and they're getting ready. So what ends up happening is basically all these people are ready, and then as soon as the market starts to show additional softening, they're going to jump. They're ready. These are people who are finger on the trigger, down payments, ready to go. And I have about 150 plus people ready to go myself. Right?
Wow.
This isn't that's accumulated in the last years. And I have a feeling as we get into the fall, maybe we'll start to see more of an actual cycle where, inventory comes in, people start buying, and then, prices get run up, and then all of a sudden everyone gets the FOMO, right? Everyone wants to jump in and buy.
Well, your pre-approvals are really a leading indicator of what's going to take place in the market, right? Whereas, what we're seeing right now with interest rate hikes, we're dealing with data that's latent, right? So, and in our last podcast, Dan and I brought it up that, demand is still percolating. We are only on the cusp of a balanced market here, and it's pushing up into a seller's market. The demand, some of these demand factors you can't change, you can't kill them, right? You have to deal with them, and so people, like you said, they're waiting on the sidelines, they're moving their money into cash, they're getting ready to go, and I have to second that. I'm having a lot of conversations right now, people all over different parts of the marketplace, from 500 up to 7-8 million. We're having discussions about getting ready to enter the market, and we've seen what happens when there's not enough supply and that demand trigger gets pulled. We just went through that, right? And it seems to be setting up for something similar.
Yeah, totally agree. And so let's talk a little bit more about that then, Mychal, in the sense of, for these new people that are about to enter the market, what does it look like to qualify today? What is that rate after today's hike?
So, we've kind of shifted our focus on how we're qualifying people. When we were qualifying people with variable rates, the issue there is that's been changing so much that you constantly have to kind of rework files. And, I would say that right now, the smartest thing that we're doing is just putting people into a fixed term, just for the qualifying sake, to give them a definitive number. That way they don't need to worry about what's happening. But just to give you an idea, right now, on the lowest variable, you're probably qualifying at about 6.85%.
Wow.
Right? So if you look at from January till today, right, you would qualify for, based on a $200,000 salary, right? And using about $1,000 in property expenses, heat, taxes, condo fees, assuming a condo, townhome fees, whatever, then you'd qualify for about 1.15 to 1.2 in January with the same 200K, right? Today, you'd qualify at about 950.
Wow.
Yeah. So
there you go.
200 to 250,000.
Yeah, 25% reduction in buying power.
Yeah.
Since February, and yet the HPI is down 4.5%, 6% now. So, it's certainly not 20%.
Yeah, and so, Mychal, are you still? I'm assuming, and from my own conversations with my own clients and things like that, we're not. At least a lot of sellers that I'm talking to, they're not entertaining a $250,000 price drop, a $300,000 price drop. If anything, they're going to wait until all these buyers pile up on the sidelines, things stabilize a little bit more, and then they'll put their property back on. So, in all honesty, I think inventory will get further strapped, and that's mostly because there's also a lot of property here that is not affected by interest rates.
Mm-hmm.
There's a lot of property here that don't owe any money.
Yeah.
Right. So,
Absolutely.
There's this is affecting people for the most part who, recently bought and people who want to get into the market right now.
Mm-hmm.
But for those people who maybe own their home for 20 years and thinking about selling, they're not hitting the market right now. And you're not going to see their inventory until things come back.
And I think, just touching on the amount of people that are not being affected, I think there's so much focus on that, but like I can tell you that on the way down with rates, I did a ton of fixed rates. Some of my clients have as low as 1.49 to 1.59, 1.69 for 3 years, 4 years still, So, there's a lot of people that are still making these low payments. Sure, a lot can happen once those mortgages come up. Where are we going to be? They're going to have an adjustment to make at some point. There's no way around it. But they also had 5 years of making arguably the lowest payments ever. So, and what has happened in those 5 years since they have bought, that their property has appreciated significantly, right? So overall, I think we're kind of getting right back into this cycle where, even if people need to sell, they're probably selling at a massive profit and they're either buying something else or downsizing, upsizing. People will have options. There's not going to be, I don't believe there's going to be this distress that people are banking on. But it's funny though, the overall sentiment though, it's just like, as the market starts to adjust down, people get a little nervous about buying, right? But as soon as it goes the other way, everyone's dying to get in, right? So, I've been having that conversation with my clients that, it is absolutely smart. Get yourself prepared right now. This might be an opportunity that you may never have again, right? And it may be short-lived. I mean, COVID showed us that, even though prices dropped, how long did they drop for? It was a couple months, and all of a sudden everyone saw an opportunity, and there was low rates, and then one of the biggest runs in history. So
I don't see how that doesn't happen again. I mean, I understand that maybe new price points, but generally speaking, when you look at recessions, which we'll probably enter into in 2023 at some point here, it'll likely be short-lived, like you said.
History
most
shown
recessions.
us that,
That's right. We're looking somewhere between 6 and 12 months, right? And 12 months being quite a long one, generally speaking, right? 6 to 8 months is usually what we can expect, and most economists will only come out and say we're in a recession after being in one for about 6 months. At which point, there's only 2 months left in that recession, and you're back out the other end. So. And that's because of latent data, right? So it'll be very interesting to see, I think, how the spring rolls around. I think, this fall is going to be a lot of waiting, a lot of trying to, tell people, hey, look, this is your opportunity to get in at a little cheaper. But if you're expecting sort of this 20, 30, 40% drop off in prices, that's just not going to happen because people will not sell, right? They don't have to.
That's good points. So I think here we should start wrapping it up. And I think part of the forward vision of what people can expect next, there are 2 more rate announcement dates preset. One of them is October the 25th. The second one is December 6th. And there's an important takeaway I want to share, and I'm going to read it verbatim because it was in the press release today from the Bank of Canada. And it states, given the outlook for inflation, the Governing Council still judges that the policy interest rate will need to rise further. The Governing Council remains resolute in its commitment to price stability and will continue to take action as required to achieve the 2% inflation target. What does that tell us? Well, they're certainly paving the way to the potential of future rate hikes. 2 more announcements this year. We'll see where that goes. Mychal will have you back on both of those to talk about how they're affecting people, and we'll be sharing how it affects the landscape. Thank you so much. I think we would love to hear your thoughts. Are your rates triggered? Has your mortgage changed? Do you know somebody who's had? We'd love to hear what's happening to you and the people, the stories that you're hearing. Please comment below. And on top of that, look, we're industry professionals. Mychal here shared a lot of information. We are somewhat generalizing because we're talking to a big audience here. But what is your situation? Feel free, call us. Our information is below. We're happy to walk through your scenario. Mychal's happy to review your mortgage status. Ryan's happy to talk if it's the right time to buy or sell. Reach out. Things are changing fast here, and we want to make sure that you are protected and well taken care of. That wraps it up for us today. Thanks as always. Have a great day.
Thanks.